Hey everyone, and welcome to today's Explainer. We're going to jump right in and cut through all the hype, all the skepticism, and objectively decode the complex state of digital assets in 2026. We're looking closely at how a technology that, used to be viewed as just a fringe experiment has steadily integrated itself into the global financial system. And more importantly, what that actually means for your portfolio and anyone trying to understand its true value today.
But before we dive into the hard data, I really want you to keep this central question in the back of your mind. Is cryptocurrency a legitimate financial future or just a market anomaly? Keep that framing as we explore how this tech behaves as an asset and how global regulations are fundamentally shifting its trajectory. This isn't just about whether lines on a graph go up or down. It's about whether the foundational architecture of money itself is changing.
So, here's our roadmap for today. We're going to cover 1. The basics of blockchain technology, 2. Crypto versus central bank digital currencies, 3. The investment roller coaster, 4. Global regulatory convergence, and finally 5. The dot-com bubble parallel. Let's build this understanding step by step.
Okay, starting with Section 1, Basics of Blockchain Technology, the Foundation. Let's establish what this technology actually is before we start talking about money, right?
Because unlike the US dollar, where the supply and circulation are strictly governed by the Federal Reserve, cryptocurrencies like Bitcoin operate entirely outside the traditional financial system. They rely completely on a decentralized, peer-to-peer network of millions of computers to establish trust. There's no bank, no government, and absolutely no corporate entities sitting in the middle of your transfer.
And here's what those mechanics look like in action. Rather than a bank approving a transfer, this vast network of computers transparently validates and permanently records the activity. When you request a transaction, that request becomes a block of digital code. That block is then broadcast across the entire network, validated, and once approved, it's locked into the chain forever. It completes the transaction as an immutable, completely transparent record.
Moving on to Section 2, Crypto versus central bank digital currencies, the ideological fork. Now that we've got the tech down, we really need to look at the two radically distinct paths digital currency is taking globally.
Notice the stark contrast in purpose here. Decentralized cryptocurrencies are built to bypass third parties. They offer users privacy, inflation protection through fixed supplies, and borderless accessibility as long as you have an internet connection. But then you have central bank digital currencies, or CBDCs. Governments are using similar digital architecture for the exact opposite reason. They're specifically designed for cheaper cash management, improving the traceability of funds to fight illegal activities, and effectively controlling monetary policy. It's literally the same fundamental technology, but driven by entirely different philosophies.
Which brings us to Section 3, the investment roller coaster, volatility in action. The tech is fascinating, for sure, but in the real world, crypto is a highly volatile investment asset. Let's see what happens when real capital is on the line.
Just think about this number. Between 2016 and 2023, Bitcoin generated a massive mean annual return of 112.7%. That is a staggering figure. It substantially exceeded traditional asset classes like global equities, US bonds, or even gold. But those incredible returns came with some extreme, stomach-churning turbulence.
Tracking the price movements from early 2024 through April 2026, you can clearly see a speculative 56% run-up tied to the 2024 U.S. elections. Optimism pushed the price to a peak near $125,000 in October 2025, but then a massive 35% decline hits in early 2026, fueled abruptly by geopolitical uncertainty and a broad risk-off environment. This is a market capable of breathtaking climbs and equally punishing drops in very, very short windows.
And comparing Bitcoin's erratic behavior directly against the relatively stable S&P 500 perfectly illustrates this. You've got the S&P showing steady, gradual market movement, while Bitcoin is just characterized by these dramatic, volatile spikes and crashes. For an investor relying on steady capital preservation, this level of day-to-day variance is absolutely a major consideration.
So why is it so volatile? Well, mostly because it lacks a consensus valuation framework. Unlike corporate stocks that have actual earnings and dividends or cash flow, or gold, which has physical commodity backing, Bitcoin has none of that. It's driven primarily by sentiment and speculation. Its price is strictly determined by what the market narrative dictates on any given day. Now, long-term holders will argue its value genuinely depends on growing adoption and belief in the system, but that belief is exactly why it swings so wildly.
Okay, Section 4, Global Regulatory Convergence, the 2026 Maturation.
All this volatility brings us to the climax of our story today. 2026 is a watershed moment where the Wild West era of digital assets is functionally ending.
I love this quote from the PwC Global Crypto Regulation Report. Regulation is no longer shaping crypto from the outside. It is being pulled into place by market reality. That perfectly captures the current shift. The ecosystem is actively demanding stability. Institutions are taking over, and regulation is responding to this massive, undeniable scale.
Policymakers are actually using a regulatory equilibrium framework to objectively balance three competing forces: investor protection, innovation support, and market efficiency. It's a tricky balancing act, right? Overregulate and you stifle innovation. Rely purely on the market and you invite fraud. But jurisdictions like Singapore have successfully found that sweet spot, attracting investment by maintaining clear, balanced oversight.
Let's walk through the recent timeline to see how we got to our current reality. January 2024, the first spot Bitcoin ETFs launch in the US. By July 2025, the Genius Act creates federal stablecoin oversight. Late 2025 brings the massive, unprecedented move of the US establishing a strategic Bitcoin reserve. And now, in 2026, Europe's comprehensive MiCA regulation is actively moving into supervision. The rules of the game are officially crystallizing.
A huge part of this maturation is the explosion of stablecoins. These are digital currencies designed to maintain a stable value by pegging to a reference asset, like the US dollar. They now boast over $13 trillion in transaction volume. Why? Because they offer the secure, real-time global transaction speed of crypto, but without those extreme price swings we talked about earlier.
Because of these regulatory strides, we've got real institutional protections today. We're talking downside-protected Bitcoin ETFs offering structured exposure. We've got SPDI charters, special purpose depository institutions, bridging traditional finance safeguards with digital assets, plus much clearer global anti-money laundering and travel rule enforcement. Everyday investors are finally getting parity with the safeguards of traditional finance.
Finally, Section 5, the dot-com bubble parallel, looking ahead. As we look at holding crypto long-term in this newly regulated environment, we need a historical anchor to understand where this might all be heading. You know, the parallels to the 1990s internet boom are actually pretty striking. Back then, you had rampant speculation, companies with zero earnings, and the NASDAQ eventually crashed 78%. But the surviving internet completely transformed the global economy. Looking at the 2026 crypto market, we see that same sentiment-driven volatility. Most of the thousands of existing coins will likely fail. However, that core blockchain utility, it shows immense potential to stick around and scale across industries.
Which brings us to our final question for anyone looking at digital assets today. As the hype fades and rigorous global standards finally take root, the surviving landscape is going to look very different. We are left to wonder, which digital assets will survive this current shakeout? Who will be the Amazons and Googles of this new digital economy? And who will fade entirely into history? It's an absolutely fascinating space and definitely one worth your objective attention. Thanks for joining me on this explainer today.